Some people go into business because they expect to make a lot of money. Some do it because they want to follow their passions. And some do it because they want to be able to take control of their own time. Whatever your reason, you're going to have to look after your finances. You have to look after your revenues and expenses and be sure you can cover your expenses every day of the year. That's not so easy to do because there are so many different types of expenses coming due at different times of the year or month. The only way I know how to get a handle on this issue is to build spreadsheets. I build spreadsheets of all the expenses I can think of and then more expenses for all the revenues. And believe me, there is no relationship between the revenues and the expenses. Once I have those spreadsheets in place, I'm in a position to figure out the cash flow. In other words, I can figure out how much money we have in the bank at the end of each month. I build financial forecasts using what accountants call EBITDA. That means earnings before interest, depreciation, taxes, and amortization. It's not perfect, and I'm the first to say that. But the whole business of generating financial forecasts is such a black art in the first place that I don't see much value in putting a fine point on the forecasts. They're only ballpark estimates at best. Now, I wouldn't say exactly the same thing if we were looking for a bank loan. One of the key issues a bank looks for, of course, is your ability to repay the loan. That means you need to factor in your loan repayments. If the bank doesn't see that, the decision makers are going to get very nervous very fast. But of course, if you factor in the interest, then your projections are not pure EBITDA. But that's okay. I put together an approach that's very easy for non-accountants to follow and that the accountants can pick up on very quickly. When accountants ask their clients to project their revenues, they expect them to come up with a result expressed in dollars. That sounds like it's easy to do, but it's not, so I don't bother asking that question. Instead, I ask my client to develop a list of things he's going to sell. This is something like the left side of a menu in a restaurant. In other words, he needs to come up with a product list. Interestingly, even if you're selling a service rather than a product, you can usually still express what you sell as a list of so-called products. When I have this list, I can put together a spreadsheet with the items for sale as the row headings and the months of the year as the column headings for a couple of years. After the first couple of years, we can change the column headings to quarters. That's because when we look out into the future, it becomes more and more difficult to project what will happen by month, so we can switch to quarters. Once I've built that spreadsheet, I ask my client to estimate the number of each type of product or service he's likely to sell for each month or quarter. Thinking in terms of items to be sold is actually easier than thinking in terms of dollars. The next step is to put together a price list. This price list is going to look very similar to a menu, as we discussed before, a menu you find in a restaurant. The left-hand side has a list of the items for sale, and the right-hand side has a price per item. Now, I have to admit that this approach is a bit rough and ready, because it doesn't allow you to factor in discounts for various promotional programs. However, it has the advantage of being simple and easy to follow. Filling in the prices should be a very straightforward exercise. Once we have the last two spreadsheets in place, building a revenue projection is a piece of cake. We simply multiply the number of items to be sold in a month or quarter by the price of that item. We put the resulting revenue projection into the proper cell in the revenue matrix. Clearly, we find the total revenue per month or a quarter by adding up all the revenue projections for that time period. Building our revenue projections this way is easy to conceive of, and it's easy to project. It gets people thinking in terms of their products and services delivered rather than dollars. It's just easier to work with. We use a much different approach to planning expenses. Here, we need to think about 4 different types of expenses. The first one is your startup operating expenses. These are the expenses you're likely to face only in the early stages. I'm thinking about leasehold improvements or initial inventories or rent you incur while you're getting set up but haven't opened up for business yet. The second expense is fixed operating expenses. These are the costs that come up month after month, whether you have a big income or no income. These are the things like your rent or telephone bill or your accounting fees. The third expense is variable operating expenses. These are the costs that change from month to month. If you are running a house painting business and you have a big job one month and nothing the next, you'll spend a lot of money on paint one month and nothing the next. The fourth expense category is capital expenditures, or CapEx. These are the costs for the things you buy that have a lifespan of more than a month or two. Things like equipment and vehicles. You can have capital expenditures for either your startup operations or your ongoing operations. Cash flow is easy to compute from your earlier spreadsheets. The first row is always your opening bank balance for the month, and the last row is always the amount of money you have in your bank account at the end of the month. Between these rows, we leave rows where you can carry forward your revenues and expenses as projected in the other spreadsheets you built. We compute our closing bank balance in a very straightforward way. We add all of our revenues to our opening bank balance. Then we deduct all of our expenses for the same period from that sum. We're left with a closing bank balance. The closing bank balance for one month is the opening bank balance for the following month.